The return on equity is another measure of a company's efficiency in generating profits. ROE is simply generated by dividing net income by the value of shareholders' equity. The higher the ROE, the better a company is at converting its equity financing to profits. Remember that we either use our own money, or borrowed funds, or a combination of the two to start a business. In other words, a company's assets are either funded by debt, which are liabilities, or equity, which is owners' funds, or a combination of both. If we only use equity to start a company, then our equity will be the same as our assets. If, however, we use equity and debt, then the value of our equity will be our assets minus our liabilities. Therefore, ROE will be the same as ROA for companies that don't have liabilities. But the two are different in companies that have liabilities. Additionally, for the same amount of profits and total assets, ROE will be larger for companies that have lower equity relative to those that have higher equity. For example, if we use $10,000 of our personal funds to start a business and we make $1,000 profit at the end of the period, our return on assets and return on equity will be the same, which is $1,000 divided by $10,000, and the result is 10%. If, however, we use $5,000 of personal funds and $5,000 of borrowed funds to start our business, and then we made $1,000 profit, return on assets will still be 10%, while return on equity will be 1,000 divided by 10,000 minus 5,000, and the return on equity is 20%. Since the value of equity can also fluctuate during the accounting period, for example by investing more money into the company, an average shareholder's equity is used, just like the way we computed average total assets, that is beginning equity plus ending equity divided by 2. Return on equity will vary based on industry or sector in which the company operates, and it is also expressed as a percentage. To determine whether a return on equity is considered good or bad, financial analysts use the average industry or sector return on equity as a yardstick. Average industry return on equity is found by taking the average of return on equities of all the companies within the industry or sector. For example, if a fashion company's ROE is above the fashion industry ROE, then we can conclude that the company is above average in using its equity to create profits, while if it's lower, then there is room for improvement. Return on equity increases as net income increases, all else being equal. It also increases as the value of shareholders' equity is reduced. Remember, equity is equals to assets minus liabilities, and therefore increasing liabilities, for example by taking on more debt financing, is one way to artificially increase ROE without necessarily increasing profits, especially if the debt is used to buy back the company's shares, effectively reducing the amount of shareholders' equity available. A very high return on equity is a good thing if net income is large compared to equity because it shows that the company's performance is strong. However, if the high return on equity is due to small equity amount compared to net income, it indicates risk. If a company makes losses, the losses reduces shareholders' equity, just like profits increases the value of shareholders' equity. When losses reduce the value of shareholders' equity, it will make return on equity misleadingly high. For example, if a company started with $20,000 of equity 2 years ago and made a loss of $10,000 last year, the losses reduce equity to $10,000. If the company now makes $2,000 of profit this year, the return on equity in the current year will be 20%, which seems misleadingly high because if the company had not made a loss in the previous year, the return on equity will be 10%. Additionally, an extremely high return on equity may signal that the company is taking too much debt to fund its assets rather than equity, and brings into question the ability of the company to pay up this huge debt. Remember, debt is an obligation that has to be settled. High return on equity could also come from profits that are one-time and non-recurring in the future. For example, gains from the sale of fixed assets might not reoccur in the next accounting period, and therefore can mislead us into thinking that the company has a stable ROE. If you have a new and growing company, do not worry if you have a negative ROE, as this is often to be expected because a lot of companies don't start making profit in the first few years as a result of huge initial expenses like advertising costs. However, if the negative ROE persists, it can be a sign of trouble. So the key takeaways from this tutorial are: Both return on assets and return on equity measure how well a company utilizes its resources. However, while return on assets include debt, return on equity does not take into account the company's debt. Also, the more debt a company takes, the higher the return on equity will be relative to return on assets. Therefore, as a company takes on more debt, its return on equity will be increasingly higher than its return on assets. Assuming profits are constant, assets are now higher than equity. Additionally, both return on assets and return on equity should be used to make apples-for-apples comparison across companies in the same industry or sector. In both cases, industries which require significant assets will likely show a lower average return. Remember, net income can be found on the income statement, while total assets and shareholders' equity can be found on the balance sheet. Having talked about return on assets and return on equity, one may wonder, why not return on debt or return on liabilities? Well, there is no need, because this is a fixed and a known amount which does not depend on net income. Interest expense is the return for debt providers. On the other hand, net income is the return for equity investors and is arrived at after paying interest expense. To have an accurate representation of the return on assets, financial analysts sometimes add back interest expense because this amount is removed from companies' profits before arriving at net income. Remember that net income is equals to revenue minus expenses plus other income minus other expenses plus gains minus losses. And interest expense on a company's debt is part of other expenses. While return on equity can simply be calculated by dividing net income by average shareholders' equity, we financial analysts usually like making it more complicated by breaking it down into additional steps using a technique called DuPont analysis. This analysis reveals which factors contribute the most or the least to a firm's return on equity. The formula for return on equity using DuPont analysis is net profit margin times asset turnover times equity multiplier. However, this would be a topic for a more advanced class. But for this class, I challenge you to take any company's income statement and balance sheet and try to compute the return on assets and return on equity. From what you have learned in this tutorial, this shouldn't take you more than 5 minutes. Also, feel free to use these 2 finance terms that you have learned today whenever you're talking to a finance professional, as you're on your way to becoming one yourself. And this brings us to the end of this video segment. If you have learned anything new about finance today, please hit the subscribe button and follow my channel in your quest towards becoming a finance expert. See you in the next video.